Everyone, my name is Harshit Goel from Birla Public School Planning. And today I am here to tell you about support and resistance and abnormalities. So, what is support and resistance? So, these are basically the levels of the market, and it is not easy for the share price to cross these levels. That is, the support is created under the share price or below the share price, and the resistance is created above the share price. So let's understand this more deeply by knowing the types. There are three types of support and resistance. The first type is based on the people psychology. It is what the people think and can be a predicted support and resistance, support or resistance. So let's assume that the share price is at 95 rupees. So the round of figure above and below the share price will be the support and resistance. Here the round of figures are 90 and 100. So 100 will be its resistance and 90 will be its support. It is very hard for the share price to cross the 90 level mark and go below 90, and it is also very difficult. It is very difficult for the share to break the 100 level mark and go above 100 rupees. Now we have the example of the ITC share. Here you can see that around the month of July and August, it tries to break the 500 level mark, but it just reached the mark and go down. That is, it was unable to cross the mark. So this is an example. Second type is based on the DMAs. Now there are 4 main DMAs that I have already told you in the previous video. So the DMA included here are 5 DMA, 20 DMA, 50 DMA, and 200 DMA. And these DMAs acts as a support and resistance. So if the DMA is above the share price, then it will act as resistance, and if the DMA is below the share price, then it will act as support. Also, if the share price crosses any of these levels, then the next level next to it will act as a support, either support or resistance. Here we have the example of the share Zomato. Here you can see the share price was unable to break the 20 DMA mark, but when after some time it breaks, then the 50 DMA in the chart there are 20 DMA, 50 DMA, and 200 DMA there. So when the price breaks the 20 DMA mark, then the 50 DMA that is next below it serve as the next support, and it stops the price to go below it. So this from this chart we can see how it works. The third type is based on the immediate high or immediate lowest level. So according to this concept, the immediate highest level will work as a resistance, and the immediate lowest level will work. Immediate lowest level before the current share price will work as a support. So how this works? So let's know about this. So for example, a company ABC is listed on the share market, and its current price is rupees 150. So what happens is that the share price goes to 140 rupees. Okay, and I, as an investor, I was thinking at when the share was rupees 150, I was thinking that the share will go down. When it comes to 140, I am still thinking that the share price will go down. So I will not buy it till 140. But on the next day or on the upcoming days, the share went from 140 to 160. So I will still not buy. But whenever the share comes from 160 to 140, now I, as an investor, will think that earlier when the share was at 140, it goes up. So I will buy it now at 140, and I will get benefit. So me, and there are many other investors like me, so they will buy it at rupees 140, and there will be excess demand. It will not allow the share price to go below it. So it will act as a support. Inversely, let's say when the share price become 160, so I invest in the stock. But on the next day or on the upcoming days, okay, so I got lost, and I will think that the company is bad. So what will be my mentality to just get rid of the share and to get it from zero loss. So whenever it touches the 160 mark, the level on which I bought, I will sell it, and there will be the condition of excess supply. It will not allow the share to move above it. So this is called this is example. Now let's understand about abnormalities. Before it, let's take example. Here you can see in the chart on the line, the first dip act as a support, and it don't allow the share to move below it. That you can see in the next dip, the next dip just hit it and go above, not breaking the support level. Now let's know about abnormalities. So it is a gap between two candles. This gap is being created because of the difference of the closing price of one day and the opening price of the next day. So like in general the candles are like this. It is the candles are near to it or beside it. But in the abnormalities condition, the candles will be like this. So there is a gap between these. So this is called abnormalities. Now there are two types of gaps. One is gap up and the second is gap down. So if there is gap up, that is the next candle is above the first candle, then the share price will come down to fill the gap. This if the share price is here, then it will come down to fill the gap. And this is the concept. Same in the case of gap down, when the condition is this, then the share price will come up to fill the gap. Here is a gap. We can see from the example of the ICICI Bank chart that when the gap was created, a gap up was created and the share price come down to fill the gap. At last, I would like to say that support and resistance and abnormalities are important factors to be considered before investing, but there are many more factors that need to be taken. So I hope you understand the video. Thank you and have a nice day.